Okay, thank you everyone for joining. We're going to get started now. I'm Kerry King, Assistant Director of the UT Energy Institute and Research Scientist here at University of Texas at Austin. So it's my pleasure to introduce and host the Energy Symposium today. Before I introduce our speaker for today, I'm just going to point out our two next talks. For next week, we have the President and CEO of the Electric Power Supply Association. So this is the industry organization for public power organizations and municipalities. And we're going to talk again about reliable, competitive energy future and trends and progresses. So a similar theme perhaps to today, how changing energy supply. And November 9th, 2 weeks from now, we'll have Jared Babula, who's a senior attorney at California Energy Commission. He's going to talk about the policies and progress towards decarbonizing energy and the state of California. But today, it's my pleasure to have Eric Danziger, who is the Managing Director of the Energy Transition Fund at Riverbend Energy Group. And we're going to hear about that today and how he thinks about this. And his title of his talk is Cleantech Investing 1.0 to the Energy Transition Investing Today. What is different this time? So I'll point out that Eric is a graduate 2 times of the University of Texas, like myself. He has a bachelor's degree in business and an MBA, both from University of Texas at Austin. Before he joined Riverbend Energy just this year, he had been involved in at least 2 companies for information services and analytics of energy. One was Innowatts, which is a leading energy software as a service provider, platform to help electricity providers optimize their businesses using artificial intelligence and using analytics to do forecasting. And before that, he was Chief Financial Officer and co-founder of Genability, a software and rate engine of analytics, provider of energy cost and savings data to leaders in the solar and energy storage and electric vehicle and home energy management space. So he's been around a lot, and I suppose a relatively short time in the energy space and business innovation and information. So it's a pleasure to have him here today, and he's going to talk about his role at Riverbend as an investor. So with that said, I'm now going to stop sharing and hand it over to Eric. I will remind everyone to please submit your questions to the question and answer feature of Zoom at any time, and I will interject these questions to Eric as the presentation goes on. So go ahead and feel free to send them in at any time, and I'll try to get them in as soon as possible. And with that said, I will now hand it over to Eric. So Eric.
Hey guys, thanks, Kerry. Does everybody hear me? Kerry, can you hear me? See my screen?
Yes, it looks good. Go ahead.
Okay, great. So like Kerry mentioned, or Dr. King mentioned, I've been in the energy transition space for about a decade. And really, my topic today is sort of clean tech investing 1.0 to energy transition. And so, anybody that's in energy right now, you've got to be living under a rock if you haven't heard the phrase energy transition. And, I've been in it for long enough that it used to be called clean tech, then it was renewables, then it was machine learning for energy. I mean, it's kind of had several evolutions. And so, my talk is, why is, investing now or the space in general different than it was, when I got into the space in about 2010. So Dr. King covered it a little bit on my background. So, I'm now an investor in the space, but, the majority of my career, I've been an entrepreneur and an operator. So, the first company and sort of my entry into the space is I started a company back in 2012 called Genability. It was an electricity rate database company and software as a service company. We sold our software to the leading solar storage, electric vehicle, and energy management companies. And really what we help them do is kind of costing and pricing rate analytics. So, what does that mean? So if a solar company or storage company is trying to price what a system might save you on electricity, the avoided cost, so to speak, it's very likely that those companies ran on our software. So if you called a solar company to go solar and they gave you a quote or a proposal on what you might save over the next 30 years, we powered that for all the major solar providers, SolarCity, Sunrun, Sungevity, Sonova, et cetera. I raised capital in that space. My first, we did a friends and family round in 11, 12. And we did a follow-on deal with a company called Veronorte, which was a demand response company in 2014. We did a debt deal in 2016. We did a majority recap with an Italian utility called Enel in 2018, and then ultimately sold the business in 2021 to a company called Arcadia. So in that role, I was on the other side of what I'm doing right now, and I'll cover that in a minute. But I will be honest, it was a different time then. Raising capital in the space was really, really tough. I then went on to a smart grid software business called Innowatts. It was actually based here in Houston, where I sit today. And I led global sales, business development partnerships. The company was called Innowatts. Again, focus more on, rate analytics as well. So you can kind of see my background. I've been raising capital for kind of renewable energy companies for about a decade. So, about a year ago, I've always been sort of fascinated with kind of venture capital, private equity. And so about a year ago, I joined an existing firm here in Houston called Riverbend Energy Group. We're about a 20-year-old firm, about 50 employees, focused on kind of energy investing, if you will. Over the last 20 years, that's obviously been traditional energy, oil and gas, minerals, non-operated, operated, et cetera. I joined to lead our energy transition efforts. And so, we seek to make direct equity investments in really the services sector of the energy transition. So if you look at the bottom chart here, that's kind of across solar and storage, decarbonization, electric vehicles, energy management. We look to really focus on sort of the services, development, and finance. So, kind of the shovels and pitchforks is sort of the analogy that people use. I mean, we're not investing in a big solar project, kind of like the one you see behind me, but, all the things that make that happen, the operations and maintenance, the engineering, the financing, so all the on the fringes. And so, we chose that as our space to focus on. One, I've like I said previously, the companies I had were technology companies servicing that space. And I can tell you firsthand that there's a lack of capital in that space. And so I know that there's an opportunity to invest there. I also know that and I'll talk through some future slides, as the transition sort of moves up into the right growth-wise, it's all those businesses that are needed to get the projects designed, quoted, up and running, et cetera. So, we launched our fund earlier this year. We're out, finishing raising the fund and as well as deploying it. Okay, so for some of the folks that maybe are too young, what happened in the early 2000s? Well, what happened was kind of following the dot-com bubble, so to speak. There was a lot of venture capital, kind of traditional venture capital, looking for its next big thing. And so when I say traditional venture capital, I mean, if you look at asset allocation, kind of a pyramid, you've got stocks and bonds, mutual funds, and the further and further you get up, the riskier it gets. And so venture capital is typically investing in early stage, go big or go home kind of thing. I mean, the average sort of rule of thumb is a venture capital firm will make 10 investments, 9 of them will go completely bankrupt, but one of them will be such a home run that it will cover all the losses on the previous 9. So they're very much in a go big or go home manner. And so, after the early kind of 2000s, after the dot-com bubble, the venture capital firms really in sort of Silicon Valley were really looking for their next big thing. And so with a lot that was happening in, solar and energy at the time, they went really hard after Cleantech. And so that, to be honest, for those that are on the phone, the kind of the Cleantech wave of kind of 2006, 2005 to kind of 2012 was, I'll be honest, was a disaster. I mean, the venture capital investors went out and raised money from their limited partners, so pensions, endowments. Collectively, they raised about $25 billion. And during that time period, they lost about half of it. And I'll cover in a minute, why that was the case. I mean, if you look at, so during that period, over that kind of 7 or 8 period, none of those companies, as you see kind of on this chart here, and this was from 2000, I believe 12, right? No exits, no IPOs. And so the way investors obviously into these companies make their money is they need they need a return, whether it's an IPO, they go public, or an acquisition. And, other places where venture tends to focus in sort of the medical, software, high growth areas had obviously outperformed in that area. The other thing around this time is there was a really big company called Solyndra, which again, if you've got students on the phone, you may be too young for this, but it's a really big solar company that had raised, they did panel manufacturing. They had raised quite a bit of money actually from the US government in the form of grants. They went bankrupt. And so, kind of during this period of 2012 or so, you have a ton of folks that have raised clean tech funds. You've got a ton of, those funds not really performing well. And then you have Solyndra going bankrupt. And so when I started Genability and we came out raising money in 2012, we had a lot of people that were just like, had battle wounds, if you will, had not done well and had not, invested in the space. If you think back about this time, this is kind of when social media was really, Facebook had obviously been around for a little while, but Twitter and LinkedIn and some of the others were really starting to gain traction. And so you just did not have an appetite for clean tech. And so it was just a really hard time. I mean, if you look at who I mentioned on my previous slide of who we raised money from, it was not the traditional, Kleiner Perkins, Sequoia, Accel, the traditional sort of, VC firms you hear of. It was, we raised money from strategics. So Shell, Energy Impact Partners, Iberdrola, these are all utilities. And then, Enernoc was a strategic, all kind of strategic based businesses. So, so that's kind of what happened in the period during that period, and why you saw this sort of mass exit from sort of what was called clean tech, which, really is at that time was kind of a dirty word. If you said you were raising money for a clean tech company or you were in clean tech, it was not that sexy. So what happened? Well, one, you had investment cycles and VC investors, and I'm on the bullets down here, they typically are looking for kind of 3 to 5 year outcomes. A typical private equity or venture capital fund is a 10-year fund. So you spend a few years raising the fund, few years deploying it, and then several years, harvesting, as it's called. Well, a lot of these clean tech businesses was taking too long. I mean, if you look at Sunrun, it was about 8 years before they got started and went public. And there were others kind of in that similar vein. So you had a lot of sort of impatient capital that was, they're ready for things to move on. And as you guys, probably see in some of kind of social media and other, some of these venture businesses, you're either on a rocket ship or you own, or you're not. And then, the other is at this time, and Solyndra is an example of this, the technology risk was not eliminated. So the innovations based on science and engineering versus software, they were just too expensive and too time consuming. So, a quote down here is I say clean tech VC failed because Silicon Valley couldn't move fast and break things. So that's actually a quote from Mark Zuckerberg. I mean, him and as well as the founder of LinkedIn say, if you're proud of your first product you rolled out, then you rolled it out too late. Meaning, you've got to be able to get stuff out quickly, iterate, continue to move. Well, it didn't necessarily work with clean tech. I mean, you can't throw up panels or solar farms or wind farms or storage systems or EVs and say, hey, that's V1. We'll just do an update and roll it back. It just didn't work that way. And so, really what happened in the 2000s is you had a misalignment of investors and companies, meaning, a lot of these companies were not venture backable businesses. And so you had kind of venture capital dollars chasing companies that really didn't need company that wanted, $1 billion unicorn within 3 to 5 years. I mean, it just, that there was just kind of a misalignment. Oh, so what's different this time? That was my spoiler alert. This was kind of a joke, but, obviously Elon Musk has done a lot for renewables and clean tech, but that's not the only thing that's different this time. So there's a couple of things, and this is what I'll cover on future slides. Over the last 10 years, the cost structures of renewables have come, way down, not just in a, they're slightly more, but they're cost competitive. And I'll talk through lithium, photovoltaic, et cetera. The other is you've got a proper matching of investors and companies, meaning you still have some clean tech or energy transition early stage businesses. You have folks like myself that are looking at investing in kind of growth oriented, that have a view of the return risk scenario of the types of businesses. You've got things like SPACs and others. There's just a bigger swath, if you will, of energy investors and the types of businesses. You obviously have a major global focus on climate change and ESG. I mean, if you have followed anything happening with the major oil companies, Chevron, Exxon, et cetera, really every company, whether you manufacture widgets or, oil and gas, everybody has an ESG initiative. A lot of that's driven by, some of it's political, some of it's, the UN has been putting out lots of reports on climate change. And, it's hard to, especially those that live in Texas, these 100-year flood events and snow in April, in February, these sort of abnormal events. It's hard to sort of ignore that climate change is not a real thing. You've got, corporates, investors, and company all focus on this. And I think you finally have acceptance that renewables it's not a matter of kind of if it's happening, it's more of, a when. And, so I think all these things, just relative to where I was 10 years ago, solar, storage, EV, this was kind of around the time like Nest was just coming out. These were all sort of, early adopter products. And so that is certainly not the case now, beyond just sort of distributed generation, but also decarbonization as well. So maybe let me pause there for a second before I go into some of the more specifics. I can't see questions, so I don't know, Carrie, if there's any questions.
Yeah, we don't have anything yet. So I think this is a nice overview so far.
Okay. Great. Okay. So, I think anybody, and, you obviously have different sides of this, but, I think for once that it's very hard to ignore and disagree that the energy transition is real and it's happening now. So this is a chart that BP, they put out every few years called the BP Energy Outlook. And really what this chart shows is global renewables generation in gigawatts, kind of forecasted from the past 10 years to today, and then going forward the next 30 years. So, really even looking out, 10 years ago, the global generation has doubled. It's basically effectively kind of doubling every 15 years or so. And this is a fundamental shift that, even BP is forecasting. And so, you look at that even more. And again, this is also from the BP scenario. And so it's a BP Energy Outlook. And so as you look at kind of today or a couple of years ago, more than 50% of energy consumption has come from oil, almost 75% from natural gas, and a very small sliver from renewables. What BP has forecasted out over the next, call it 30 years is a rapid scenario, a net zero, and a business as usual. And even in sort of the varying scenarios, and obviously the assumptions regarding economic policy, social preferences, in the rapid scenario, carbon emissions from energy use will fall around 70%. That's huge. I think even in sort of the business as usual case, we've got emissions in 2050 less than 10%. So I don't think there's a scenario, and I think, investors look at this, corporates look at this, there's any scenario where you look at that says, hey, in the next 10, 20, 30, 50 years, will the primary energy source be oil and gas or fossil fuels? And even being a renewable energy guy, I do believe we're going to need it all. As you see here, I think over the next 30 years, we're not in our lifetime where we see, traditional oil and gas or traditional fossil fuels go away completely. There are certain forms that are, just not, whether it's nuclear, coal, et cetera. But it's a fundamental shift. And so because of that, I think there's acceptance and adoptance that now means, okay, this is happening. How do we invest, or as investors, capitalize on this? And so this chart is really impactful in terms of, what's different this time versus last time. I think it's hard to ignore whether you're a venture capital, private equity, debt, whatever business you may be in, that this is happening, and what side of the equation or supply chain, if you will, do we want to play in? So, a couple of other sort of really interesting things that have happened over the last couple of years. So, there's been quite a few significant regulatory, political, and commercial momentum. The first is, the Paris Agreement. This is a pretty massive thing that, the US obviously pulled out of during the previous administration, as rejoined. But the goal there is for net zero by 2050. And so, these goals don't just happen overnight. And so being zero carbon electricity generation in the US by 2035 contributes to all the things happening in the Paris Agreement. You've got a number of kind of building and energy efficiency, initiatives underway. The second, in sort of this piece down here that drives that is, electric utilities that, in most of the country are regulated, for many, many years have been coal. And so you've got, almost 40 utilities in the US have carbon-free or net zero emissions by 2050. At the end of the day, whether you as a homeowner put on solar or storage on your roof, you flip the switch on the wall, you want the powers to go on. Unfortunately, many people don't necessarily care where that comes from, but you've got, growing number of regulated utilities in the US going to say that we will be, carbon-free. You've got 70 customers in the US served by utility, 70% of homeowners that live in a utility that have a carbon emission goal, and another 60 or so in the US that have publicly stated carbon emission goals. And so you've got, like I said on the first slide, more and more folks, especially the bigger producers. So, if I stopped emitting CO2 tomorrow, probably going to make a small dent, not make a small dent in the overall CO2 in the atmosphere. It's going to require the efforts of utilities, heavy machinery, manufacturing, et cetera. So again, all of these things have played to, investors looking at it saying the global macro trends are here and happening. The other thing that sort of came on the scene about 12, 18 months ago was these things called SPACs, special purpose acquisition companies. It's a pretty interesting, financial concept where it's called a reverse merger, where effectively, a company goes out and raises a pool of capital, effectively looking for a single deal to take a company public. They've been around for a little while, but as you see in this chart, in January of last year to kind of, January of 20 through kind of the end of 20, there was just this massive uptick last summer and kind of into Q4 of last year on clean tech focused SPACs. So, you're effectively, a private equity sponsor will go out, raise what's called the SPAC, price the SPAC. They will then raise they'll find a deal. They effectively have 2 years to find a deal, and they'll take a company public. I won't go into the debates on it. There's a lot of folks that have varying views on are SPACs the right vehicle, but at the end of the day, you've got this flood of capital coming into the clean tech space, and so it's created sort of this excitement and energy. And so what you see here is, just the sheer volume of, several $1 billion. They're targeting more kind of earlier stage companies, or, may not have, they're pricing the businesses, further down the line. Hard to ignore in this stat's, I think, a little bit older, but, there's been a lot of conversation around the infrastructure plan. So, almost $2 trillion, coming into the space. A little over 30 billion coming to the market through SPACs. And so you just have this I say flurry of activity, but excitement into the space. And so it's created other firms and institutional managers to say, okay, costs are coming down. There's a lot of regulatory and sort of political support. This is a thing that's happening. And so how are we going to play in it? So, every investor group has a different approach, but that's kind of the piece that's really, one of the things that's really sort of saying, okay, this thing is happening. So I'll cover a couple of kind of more market segments. I would say the biggest thing across the board in all of these, solar storage and EV is just cost competitive. A lot of venture and private equity firms really won't touch things that say, hey, the only way this company makes money is if they get government subsidies. So if you look at the bottom chart here, when I got started in solar and storage, it was almost $6 a watt in the US for solar. Fast forward to today, it's almost 3 to 4 times cheaper. You're around $1 a watt. That is crazy, and it's and only continuing to fall. And so when you compare that with traditional generation, it's a real kind of game changer. You look at in the US residential solar forecast, we've kind of stabilized a little bit. There was forecasted a dip, which, was based on something called the incentive tax credit. That's been extended, and you see that growing, up into the right, global PV installation, as well. So you look at these things and saying, okay, they're continuing to grow. they've historically grown, and now they're really continuing to grow to sizable things, and this is here to stay. And so, all things pointing to okay, all the things that make these wheels turn are going to require capital, and how do we as investors participate? You're seeing some similar things in energy storage. Energy storage is kind of a personal interest of mine. I think as you think about solar and wind and other things to really make them sustainable, you've got to be able to store and use that power down the road. So similar kind of chart here. I mean, energy lithium costs with lithium is the primary lithium ion is primary material in energy storage as well as electric vehicles. Again, over the last 10 years, the costs have come down almost 80%. And they're still forecasting even more significant cost reduction. So, that drives, the cost of EVs, the cost of systems. You're also seeing finally now they've been in the market long enough for, battery recycling businesses. So, if a 10-year-old Tesla maybe has a lithium battery, it can be refurbished, replaced, et cetera. So again, I mean, over the next 5 years, having almost 8,000 megawatts installed in the US is a phenomenal feat, given that we're, literally at 2,000 right now. So that's pretty significant growth over the next 4 years. And then you look at global, I mean, it's insane. Just almost 800 gigawatts, over the next 10 years. And so you will start, and we've already started to see a point where, solar was sort of first on the game. Storage was kind of was on a small subset of systems. You're seeing almost kind of 30% of residential systems now being priced with storage, and I would say 50% on the commercial side, where they used to kind of be separate. Now it's if you're going to install a solar and storage system, the economics are there, the financing is there. I mean, it's a real cost competitive opportunity now. And then the last piece that I'll touch on again that I think is driving and attracting investors here is I think the EV market has been probably more mainstream, if you will, than solar and storage. I mean, as I showed a picture of Elon Musk, I mean, I think Tesla's done an amazing job building a brand. They to be the largest car manufacturer in the world, and have not been by market cap, and have not been wasn't manufacturing cars 15 years ago. It's pretty amazing what they've done. Now you look at that and you say, okay, well, Teslas and Model S and Model X, et cetera, are, really toys for rich people. Well, they've done a great job of obviously reinvesting. There's been a large number of companies coming out with, plans to be the most notable one is Volvo has said by 2030, they will only be manufacturing electric vehicle cars and will end of life internal combustion cars. I think that's a phenomenal statement. And I think every car manufacturer has some EV, but have not made those commitments. I think we'll see more and more of those, especially as the costs come down. So, by 2040, long range EVs, which may be $100,000 cars today, will be almost $20,000, and EVs will displace a significant amount of crude oil over the next 15 to 20 years. So, you're seeing significant cost reductions in EVs. The other is just the infrastructure that makes all these things work. I mean, EV charging stations are on the rise to double by the 2025, and really over the next 5 years, increase 500%. I mean, that is just insane. Beyond just having them in your garage, but being able to publicly charge. I mean, my hope and aspiration is that my children and others, this notion of a gas station may be an obsolete thing. Kind of the modern day milkman, if you will. And so you look at EVs on the road in North America. We're expected over the next 10 years to have 20 million, up from little over 3 million today. I mean, that's just phenomenal, and similar growth on the EV. So, obviously these are forecasts and projections, and, these tend to, as in any of the case, can be wrong. But I think, you look at every single one of these scenarios and you say, okay, costs are coming down, growth is happening, adoption's happening. There's policy and political ramifications to make that happen. I mentioned Exxon earlier. For those who didn't see it, they had an activist shareholder group that effectively kind of took over the board, if you will, earlier this year with some issues around their ability to move and enact ESG initiatives, and that's pretty amazing too. So it's all those things that kind of forced me to say, okay, I've always been on the other side of the transition. I've been raising and growing businesses. I know that there's a gap in some of these markets, and I think you'll see more and more of folks like myself coming into the space because either they got burned in the first wave of clean tech and know that this wave is different, and that the transition is here to stay. So that's all I have. I tried to keep it at 30 minutes. Maybe it was I talked a little fast, but I'm happy to answer questions, and hopefully, Dr. King, that was what you were looking for.
Right. No, that sounds great. We got a couple questions coming in here, and in general, people are wondering about sharing slides, so you can decide that later. And I can follow up with you later if you care. So, okay, you can give to me, or if I can be the vehicle for that. So I'll saying that to people online now. I'll ask for them from Eric, and then you'll have to ask them from me. If you don't have my email, then the General Energy Institute information website, information email address on our website. But to the questions here, so here's one on SPACs, and me being sort of engineer and macro modeling guy, you might highlight a little bit more what SPACs are. But this person is asking, that says SPACs are interesting, and in spite of high commissions, do you have any recommendations as to decent analysts in this space? Since they're in more realistic territory, I guess SPACs are more of a thing. So, why did they become a thing in the 2020s, as you show? And is that unique to renewables or clean tech, or is just renewables and clean tech are part of the general SPAC wave? I don't know if you can give any. How do you play in that at Riverbend? Is it SPACs important to you?
So SPACs are not important to me, but so really what happened with SPACs is you as interest rates were and are continuously low, you have these massive pensions and endowments and others that are, quite frankly, looking for yield. I mean, it's been hard the last couple of years with the public markets the way they are. Everything's been up, and you've got large folks like Wellington, Fidelity, et cetera, sitting on more cash than they know what to do with, and they can't invest in the bond market, if you will. And so they were looking for sort of areas to put money. And so what SPACs allow them to do was say, hey, we're not going to invest in this single deal right out of the gate. We're not going to, we're going to invest in a management team, which I think Lisa mentioned is there's a misalignment on SPACs. And I'm by no means the SPAC expert, but if I go out and I raise $1 billion SPAC, what ends up happening is, I go out to the public markets and I say, I'm going to acquire a business. I'm going to go find a business that does X, and I'm going to take it public. And, as opposed to investing in a fund where you've got kind of blind pool risk, what ends up happening is the guy or the fund that gets, puts the deal together, I get 20%, I get a redemption of 20% of the company. So let's say, if I find a deal and we price it at $1 billion. The company's worth $1 billion. Me setting up the SPAC typically will cost somewhere between $6 to $10 million. So effectively, in a year and a half, I put together, call it $10 million, lawyer fees, bankers, et cetera. I went and I found the deal, and I priced it, and we took it public. And it was $1 billion company. My $10 million that I put that together, now it's $1 billion company. And now I own 20% of it. So I effectively turned 10 million into 200 million. And so you've got private equity firms that have said, okay, well, we want to raise $1 billion SPAC. You've effectively, there's plenty of stories about this where, a company went public at $1 billion and they maybe had 10 million in revenue last year. So you've effectively, they're obviously saying, well, we're valuing it at 2027 revenue or something like that. You are creating and sort of using SPACs as an avenue for more venture type investings. And so that's a little bit of color on it. got any recommendations as to recent analysts in the space. I do not. I know like Barclays and Lazard have been really active in the SPAC space. And sorry, I meant to specify SPACs with clean tech startups. Yeah, I mean, you can Google it. They've a bunch have raised in, and I'll send it around. There's a link that has them all. I mean, Carnelian, NGP, First Reserve, several others have raised SPACs. I think the reason that they've kind of attracted this space is, they're not looking for sort of venture-backed businesses where they've got no revenue. They're looking for sort of growth-oriented businesses. And so you had a number of kind of generalist energy funds that were sitting on a ton of cash from sort of funds they raised a couple of years ago. And, there's not a lot of activity happening in the fossil fuel space. So they're sitting on a decent amount of cash. They're looking for deals to do. And a SPAC provided kind of the most attractive mechanism to do that.
Right. We got this other one here asking your opinions on fuel cell electric vehicles versus battery electric vehicles, and anything you think on that kind of.
Yeah, I mean, I love it all. I actually think hydrogen cars is going to be amazing too. I mean, I think the hydrogen market is phenomenal. And I think as we look about, batteries, fuel cells, hydrogen, I think we will start to use the word EV as sort of just a generic word to mean non-internal combustion. So, I'm not an expert by any stretch of the imagination on hydrogen or fuel cells, but I think you will see them kind of go hand in hand.
Right. There's another one on maybe sort of batteries and supply materials, I guess, in the chat window. How does your firm look at companies that might be looking at other types of storage technologies besides lithium ion and looking at other things? Is that inside your scope or outside of your scope?
Unfortunately not. So we're trying to tend to look at sort of revenue generating opportunities. So anything that's sort of early stage technology, things of that nature, we're not investing in. I'm happy to make some recommendations on others that are. So let me read this other one. It's great to see capital moving to address these opportunities, and thanks to all the parties that brought it down. What are the important funding gaps? Money, but isn't. I mean, I'm obviously invested in the services sector, so I think that's an area that's under invested in. I think EV and batteries has been really attractive to a lot of folks. Resi solar, I think is one that has room to grow. I mean, it's hard to know right now. Any
right. Here's one on carbon credit certifications or some kind of market about carbon prices or maybe carbon credits in general. Is that something that would interest you all, or how do y'all think about that as a service?
So that's
energy.
Yeah. So I don't know. I'm not looking at kind of carbon. I mean, I'm familiar with carbon credits. I haven't looked at it in terms of sort of any opportunities for VCs in this area, meaning, there's definitely companies. What's one of them? Just Energy owned one that did kind of cap and trade or carbon tax credit marketplace for trading. There's definitely opportunities there. Not an area we're focused in, but I mean, that's the kind of stuff though. It's where it's on the fringes, if you will, of energy transition that I think you will see more and more happen there. Which I think goes to the next question. How does the investment community view technologies that are important for? So yes, I mean, that's the kind of thing though, but I think, and your question on this, I don't think it's as far away as people are thinking. And so, what you that's what I think happened in 2000, early 2000s is you had venture investors that were looking for 3 to 5 year return. And you now have folks that may be looking at sort of, decade technologies away that have a different investment horizon. So, pensions, endowments that are not looking for a 3 to 5 year, scenario, they're looking for, they're okay with a 5 or 10 year hold. You've got just a different set of investors looking for different things. Whereas before you had venture capital only, Silicon Valley only dollars chasing these types of deals.
Yeah. Well, in terms of Riverbend and energy transition, how do Is there something you can say there without spilling your secrets
No,
in
I'm
terms
happy
of
to.
the time horizon of interest to you and the types of investors you're trying to get involved with? Longer time horizon investors?
We're kind of probably more in the middle, to be honest. I mean, we're not looking
And
for,
middle is how long? Yeah.
I would say kind of 5 to 7. We're not looking for, a quick exit. We're also not looking for a 15-year hold period. We're looking more at, active growing businesses. I think in some cases, some of the deals that we're looking at could be sold to a SPAC. So those obviously have a shorter time horizon, but, we're not looking at businesses where, like, I'll use a Facebook or a Google or something like that, where, they're doubling and tripling revenue, during that venture period. And that's typically what ventures looking at, 100% revenue growth year over year. I mean, we're looking at kind of more the 20 to 30, maybe even 40% revenue growth. So, by all definitions, still high growth businesses, but not, venture backed, but also not, the technology risk is eliminated, meaning we don't need them to be profitable, but we need them to be revenue generating, meaning there's something there. They've developed a business or a product that is needed. They need capital to continue commercializing and growing it.
Okay, that makes sense. Yeah.
Yeah, and there's different funds that do now. I think, like I said, you've got different players looking to do all the above, which you just didn't have. You only had venture. When I was raising money, you had venture and you had, quite frankly, like Department of Energy grants, which I had gotten a couple of those in my first company. And so we had to be creative and go into strategics that, to be honest, don't really have kind of an investment horizon. If a strategic, in our cases, when the strategics that invested in us, they had a different incentive or motivation. They were, interested in what we were doing. They wanted a seat at the table. They wanted to keep an eye on what we were doing. They maybe wanted to acquire us. I mean, they were not as interested as, a return on their capital, so to speak.
Right. Okay. I think you had this other one here about funding gaps. I don't know if you kind of said that from one of these questions. What are the important funding gaps that you see in the clean tech space, and what should be getting more attention? I mean, I guess you, in theory, you're trying to fill some of these, and maybe
I'm trying
that's
to
the
fill one.
secret
I'll
sauce,
I'll tell you one that I think is still kind of a broken model is, the regulated utility space. I mean, it's the fact that it's a complete monopoly, and, anybody sitting in Austin, I mean, you have Austin Energy, whether you want to or not. You're not a customer. Look at your bill. They call you a ratepayer. I think that's a market ripe for disruption. In Texas, in Houston, we're deregulated. So we have our choice. And if you don't like who you're using, same thing, you don't like your grocery store, you go on to the next one. Nothing against Austin Energy. That's how most of the world operates, or the US. But, I think that market has been, is largely, and I worked on it in Innowatts, is largely, just sort of the status quo, this inertia effect. And so, if Austin Energy told you you're not going to have power for 2 days, you'll be pissed and there'll be an uproar, but what are you going to do about it? And, if they change your rates, I mean, not much you can do. And so, I think that that has forced a lot of folks to kind of invest in technologies that say, well, why do I need to be dependent on this company? Could I go off the grid and be my own microgrid? Could I, just different scenarios. So that's an area that I find fascinating.
Yeah, I guess we get to go down to the city council and tell them what to do or how to direct Austin.
Yeah, what good that does.
Get annoyed. But they, let me just push back a tad on the advantages of something like a municipal utility. That if you are investing in demand management services or efficiency and these kinds of things, the investments are contained within the community that pays for it, which is to say the service territory of Austin Energy. So, that's different than Houston. So do you think about companies or the possibility for expansion of companies providing energy services that are, if it's more applicable in a municipal or other regulated environment versus a restructured retail or wholesale environment?
I think absolutely. I think it will not be too long till we are getting power from kind of non-traditional folks. I think you have a lot of interesting companies out there household names that we all know of that will likely be your energy provider over the years. I think it's one of those things. Most people, they want, reliable product, relatively, affordable product. You don't have, at the end of the day, especially in Houston, like, what's the difference between your energy? Some obviously want it to come from solar storage, but there's no reason why, depending on where it comes from, you couldn't be getting your power from your cell phone provider, your home provider, your home internet provider, your insurance provider, your bank. And I think you will see more and more sort of, the phrase is kind of utility in a box providers, sort of non-traditional folks providing you power. I think we all, people's lives are getting busier, having another thing to manage. I think we all look at it, it's like, okay, Comcast used to call it the triple play. I mean, it was this novel concept 10 years ago where you're like, wait a minute, my cell phone, my home phone, and my internet can all be one. That's amazing. Now we don't think of it any other way. I think, we all, businesses do this, but we all as homeowners want, vendor consolidation, if you will, like one bill to pay, one person to complain at. And so I think you'll see more and more of that. Especially, in California, they've got this thing right now called CCAs, community choice aggregators. So we may go kind of in this hybrid approach, if you will.
Yeah, I don't know. You made me start thinking of Enron too, when you start talking Comcast and providing all these services.
Yeah, that's exactly right.
I just rewatched the movie Smartest Guys in the Room a few months ago. So here's another one, kind of referring to calling you a fan of deregulation. So it's just a question about, do you think deregulation, in the electric sector, I guess broadly, played some role in what she's just calling snowmageddon, essentially the February blackouts? Or how do you think about investing in the space of a more reliable grid, even when you have multiple providers and sellers of electricity and companies like Griddy, who've not around anymore? And I guess they just legislated a concept like Griddy out of possibility in Texas. But I don't know. What do you think about resilience investing in terms of climate change?
I mean, I think, the grid has obviously room. I mean, I lived through that. I was two little kids, a dog and a wife and I, and in-laws with no power for a week in Houston. And it was terrible. And, you look at that and you say, well, how does this happen in the US? And how does this happen in certain, parts of the country like this? And, I don't blame deregulation as sort of what happened with snowmageddon. I'm happy to share a blog post I wrote on the topic, but, I think we in Texas, obviously ERCOT caught a lot of heat and there's differing opinions, but my opinion on that is, the real sort of culprit here on what caused snowmageddon or Uri was climate change. I mean, we prepare in Texas our power grids or our power plants for really hot summers. That's the way it's been forever. And so what happened is in February, we took a number of scheduled maintenance, if you will, facilities off the grid for getting ready for a hot summer. And so when we call them 100-year events, but we had Harvey, we had the Memorial Day flood, the tax flood, snowmageddon, et cetera. When that happens, it was sort of ERCOT really had no choice. I mean, in many cases, ERCOT is really like an air traffic controller. They're managing demand from their customers and they're managing supply from the, now there's a lot of stuff they could have done better with communication and transparency and pricing, et cetera. But when they, a week in advance, they knew they were going to have a really bad situation on their hands, because what ends up happening is retail energy providers in deregulated markets, as well as regulated markets, they submit a forecast. So they submit a 30-day, a 15-day, a 10-day, a 5-day, and then even a day ahead. They submit to ERCOT, here's how much power we need over the next month. And then they get to refine it as it gets closer. And that demand that they ask for, they're basically putting in a bid saying, hey, power producers, here's how much we need. But as it gets closer, if they have to deviate from what they originally kind of put in for, they have to go out in the open market and they pay an arm and a leg for it. So you want to be as precise as you can as it gets closer and closer to it. Well, as it got closer and closer to it, people are saying, holy crap, it's going to be really cold, in negative weather, whatever, freezing weather in February. People just ramped up, heat went up. So there was this a massive spike in demand. And ERCOT is saying, well, you guys didn't put this in 30 days ago. We didn't know this was happening. We can't create the power overnight. And so when obviously demand exceeds the supply, what happens? The system just crumbles. And so, I'm a fan, as Julie said, I'm a fan of deregulation as well. I don't see that, having any play in Snowmageddon. I mean, really the culprit there, I mean, we all want to point the finger at ERCOT and whatnot. To me, the issue was,
there were 20 plus gigawatts of dispatchable power off and,
unpredicted
and all kinds of wind power off and natural gas supply. So it was a combination across the board of various failures. So that's
so
another
solution.
Some of them were regulated utilities and some were not, right? Some were power.
So the thing I've said to folks is we can have reliable power year round. It's generally, not necessary in the winter months in Texas. But if we want reliable power year round, guess what? The utilities, they're regulated utilities. They pass on every cost to the ratepayer. And so, us in Texas have relatively, cheap power compared to kind of our friends in California. And so if we want to have backup power all year round, during kind of the February, March, when we're typically gearing up for summer, I think people would say right after Snowmageddon, heck yeah, we want it all the time. But, when their kind of March bill, I'm just making up numbers, goes from $100 to $200 or $250, and their summer bill goes from $200 to $600, you can't have it all. And so, I don't necessarily view all that happening as an issue of deregulation. I think deregulation is good. I think, even in capitalism and entrepreneurship, I mean, if you've started a company and the minute you find out you have a competitor, there's a part of you that's like, crap, we have competition now, but there's also a part of you that's like, okay, that means I'm in a market that, we've got to show up every day and do our best job, which, I think I'm trying to skim Matthew's notes.
You got one person, pushing back on more pro Austin Energy things. I don't know if it calls us ratepayer in our bills. I consider myself, I guess, a citizen.
And Julie, you said our razor thin capacity that is encouraged by deregulation is my concern. It's a great point. I mean, you're also incentivized. I mean, it's not a lot of money to make in that space. And so my view is, I think before Snowmageddon happened, and I'll be honest, I was a Griddy customer for many years. I think there's a hybrid between having 150 reps and one regulated. There's probably kind of a middle ground of, the right number of folks.
Right. I think I share the concerns of the person here talking about the pressures of at least the market structure of generation and thin margins and trying to make money off of, it's highly competitive, and it's going to get more important to manage all these different supplies going forward. So I don't know if that's a space y'all look to help. I don't know, helping ISOs, that's probably not a great revenue maker, but if someone has better demand responses, something like demand response instead of just generation, is that part of your potential investing area? So I mean, that's more back to your history, I guess, thinking about all kinds of management. Right. And it seems to me that's probably going to be more important going forward. Is that how you see, just that area?
100%. I think, just managing, as is anything, managing supply, demand, and sort of the efficiency of things is spot on.
Well, that's kind of our set of questions here. So I think if anybody's got something else, maybe try to submit it. But I was kind of a fire hose, different thoughts there after the initial presentation. So I thought that was pretty good and informative, just getting your thoughts on things and how, I've learned about, a little bit more about SPACs here than I did, or what are they, special purpose acquisition companies, or so more than I certainly did before this talk. So
I'll send you, Dr. King, my slides, and for anybody that wants to reach out, I'll put it in the deck that I sent around. But my email is just Danziger, so EDANZIGER at riverbendeg.com. Feel free to reach out. I'm happy to be helpful if I can, and appreciate the debate and questions. So if anybody disagrees with anything I said, I'm sure I'm wrong.
There you go.
Feel free to rebut me.
That's right. If we say enough words, we're going to be wrong for sure. So, all right. Well, thank you very much. Eric Danziger of Riverbend Energy Group and part of their managing their energy transition fund. Thanks for joining us. Thanks for coming back to UT Austin, at least virtually, for this presentation.